While high income earners typically make pre-tax contributions to their 401k account because they're in high tax brackets and they're trying to reduce their income and save taxes, there are definitely situations where high income earners should revisit that decision and start making Roth 401k contributions to their retirement accounts. Many high income individuals are usually surprised that they're even eligible to make Roth 401k deferrals because they don't realize they don't follow the same rules as Roth IRAs. With Roth IRAs, once you're over a certain income cap, you can no longer contribute to a Roth IRA, but for Roth 401k, there is no income limitation. But 401k plans have what's called an aggregation rule for deferrals, which means you're not allowed to contribute the max amount pre-tax and then also do the max amount Roth to a 401k. It's a combination of the two. So for like 2024, the max deferral limit is $23,000 for an individual under 50. For an individual 50 or older, it's $30,500 with a catch-up. Now, someone could decide to do $23,000 all pre-tax, $23,000 all Roth, or any combination of the two. The first scenario that we're going to cover where it may make sense for a high-income individual to make Roth 401k deferrals is a business owner that's just having an abnormally low tax year. Maybe the business took a hit, or maybe they made a big investment which reduced a lot of their net income from the business. They're used to showing $300,000 plus in income, which is throwing them in the higher brackets. But let's say this year they're only showing $80,000 in income. If they're only showing $80,000 in income and they're a married filing joint, their top Fed tax bracket right now is 12%, and the one above it is only 22%. So we'll ask those clients to say, when are you ever going to be in a 12% bracket again? And a lot of times they'll say, probably never. I expect the business to rebound. Even in retirement, I'm going to be in a higher than 12% bracket. So we're like, well, then why are you doing pre-tax deferrals? Because pre-tax deferrals is taking it off the table now tax-wise, pushing it later on when hopefully you're going to be in a lower bracket. But if that's not going to be true, if this is a weird low bracket for you, why not realize the tax on that now, put it in the Roth source so all that accumulation you get in the future is tax-free. The second scenario is a change in employment status, and there's really 4 subcategories within this section, and the first one being retirement. Let's say we have a high income earner that's used to making $400,000 a year, but they're going to retire in February, so they'll only have income from January and February, so maybe they're only showing $70,000 worth of income. Normally they'd say, well, I want to max out my pre-tax 401k before I retire. And we're like, wait a second, if you're going to only be showing $70,000 a year in income and you don't have a lot of income surprises for the rest of the year, maybe you just do that all Roth, since you're going to be in an abnormally low tax bracket, even though you're showing 2 months worth of income. For spouses, maybe one of the spouses has a change in employment status, whether they get laid off for part of the year, whether they voluntarily decide to leave the workforce to stay home with a child. Like all of a sudden they have a much lower bracket. And then if that spouse that stayed home plans on re-entering the workforce at some point, you're kind of in this narrow window where you might have a few years in a lower bracket. So it may make sense to switch from pre-tax to Roth. The third is a reduction from full-time employment to part-time employment. Sometimes as people get closer to retirement, instead of fully retiring, they just decide to scale back. So maybe they were making $200,000 a year and they scale back to a W-2 consultant and they're only making like $70,000, $80,000 a year. And again, they're in that scenario where they don't think their income rate is going to drop in the future. So they might switch over to the Roth side instead of pre-tax now that they're out of those high brackets. And the fourth one in this subcategory is someone that just leaves a high-paying W-2 job to go start their own business. So a lot of times when you go start your own business, there's a ramp-up period for a few years where you're trying to generate more income out of that new business, but you're in a low bracket for the first few years trying to get things up and running. So it may make sense to do Roth instead of pre-tax because you really don't need the tax deduction until your income starts going up. I think in general, sometimes people underestimate the huge value of Roth compounding over longer periods of time. So if I give you an example, let's say you're 40 years old and you defer $23,000 in your 401k plan, and you get an 8% rate of return at $23,000. And let's say you did it all pre-tax. In that scenario, it would grow to $157,515 by the time you turn age 65. And when you withdraw all that pre-tax money, that's when you have to pay tax on it. Now, instead, let's say you do that same $23,000 to a Roth 401k, the same 8% rate of return. You reach that $157,515 again at age 65. Now, because it's in a Roth source, you're able to draw that full $157,000 and change, all tax-free. Scenario 3, where it may make sense to make a shift, is high-income earners that just have way too much in pre-tax retirement accounts. Sometimes you have these high-income earners that have been maxing out their pre-tax retirement accounts for 30 years, and they've amassed $3, $4, $5 million all within these pre-tax accounts, and then they go to retire and they realize there's something in their future called an RMD, a requirement of distribution, which is at certain ages, somewhere between 73 and 75 right now, the IRS forces you to start taking distributions out of your pre-tax retirement accounts, whether you need it or not. For example, if you have $3 million in a traditional IRA or a pre-tax 401k plan and you turn age 73 in 2024, your RMD for that year would be $113,207. And that's the amount that you would be forced to withdraw out of your pre-tax account and pay tax on it. And that's just a start of your ordinary income. You might already have Social Security, you might have investment income, you might have pensions, you might have rental income to stack up on top of that. But the whole idea is those RMDs, and then you stack all your other income, it could jump you up into higher brackets. If you realize because of these RMDs that you may not be in a lower tax bracket when you start stacking up all your income in retirement, that could then swing you back to say, well, then maybe I just do Roth now, pay the tax because I'm never going to be at a lower rate, and then at least I'll get the accumulation tax-free in the future when I take this money out. The fourth scenario is a desire to create multi-generational wealth. So a lot of times when people are approaching retirement, they'll sit down with a planner like us, start mapping it out to see where they're going to be drawing money out of and to make sure that they have enough to retire. And when we do those projections, they realize, oh my gosh, I'm going to have a bunch of money left over that's essentially going to go to the kids. And the IRS recently changed the rules for non-spouse beneficiaries that say, if you inherit a retirement account, you got to deplete that account and potentially pay tax on it within a 10-year window. So if one of your kids inherits, let's say, a $2 million pre-tax retirement account, they're going to have to pay tax on all that money in a 10-year period, which could then bump up their income bracket, where instead, if you decide I've got enough for me, really this money ends up being for the kids, maybe shifting over to the Roth side of things, saying I'm still able to make these big 401k Roth deferrals. Now you accumulate all that money. It's tax-free over time, but then when the kids inherit the money, they still have to take it out with a 10-year period of time, but there's no taxes due on that money because it's Roth. And even better, when they inherit that Roth retirement account, they can accumulate it for another 10 years because of the 10-year window and take it all out in year 10, potentially giving them the opportunity to double it again before that withdrawal happens. Another added advantage with this multi-generational wealth is Roth accounts do not require RMDs or requirement distributions. So like I mentioned with pre-tax accounts, you hit that 73, 75, they force you to take money out and pay tax on it. Roths do not have that requirement. So if you've accumulated Roth, you get to keep accumulating so that tax-free bucket just keeps getting bigger and bigger and bigger. The final scenario we're going to talk about is a tax diversification strategy. So sometimes high-income earners will contribute both to pre-tax and to Roth within a 401k to diversify that in case tax rates go up in the future. So while you might be in a 24% Fed bracket now, even though your income might drop a little bit in retirement, what if tax rates go up because of the huge government deficits, and at some point the government has to bring in more tax revenue to pay all that stuff back? So in the 401k world, it's not an all or nothing decision between pre-tax or Roth. You just have that $23,000, $3,500 limit. But you can do any combination of pre-tax and Roth. You can do half pre-tax, half Roth, and by having some of your money in Roth, while you may be paying tax at a slightly higher rate now, that source is building up might protect it that if tax rates go higher in the future, you've already paid tax on that money and you get tax-free accumulation. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.